Hey, everybody. It is almost June already. It will probably be June by the time you're watching this. So, thanks for joining us. We are going to talk about some of our favorite investment opportunities right now. There are some stocks that just kind of look like no brainers, even with the market near all time highs. Before we dive into what we're looking at right now, please take a minute and check out the link you see on your screen, fool.com/Frankel, for the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So I got to say, and I've talked about it before, one of the biggest no brainers in the market to me right now is PayPal, ticker symbol PYPL, but for different reasons than I've talked about in the past. The stock is down 80% from its highs. It trades for about 14 times forward earnings, even though it has billions of dollars of net cash on the balance sheet. It's generating about $5 billion of free cash flow each year, and management is investing heavily on stock buybacks. Tyler and I have talked about a lot of these tech companies, especially fintechs, that dilute shareholders over time by with all kinds of stock-based compensation. PayPal's not one of them. Their share count has actually gone down by 11% over the past 3 years because of aggressive buybacks. Management clearly thinks the stock is a value, and I do too. So, anyway, the point of that first part is it's essentially being priced for zero growth. And it's not hard to see why. The user base has not only stagnated, it's actually kind of declined a little bit over the past couple of years. PayPal's user base increased by 0.4% sequentially in the first quarter, but was down year over year. It has 427 million users. A while ago, it said it was going to get to 750 million pretty much by now. So clearly, that wasn't a realistic projection. Um, there's very low profit margins in the space. There's concerns over increased fee pressure over time, lower take rates and things like that. Definitely valid concerns. Um, PayPal has an entirely new management team. I don't know if people are aware of that. A lot of people know they have a new CEO, Alex Chris, who came from Intuit. But essentially, PayPal's entire executive leadership team has only been there for a few months at most. Some are brand new. So trust the process. Give them a little time to figure out what they're doing. I like what they're doing so far. They're incorporating, I hate using buzzwords, but they're incorporating AI into their business in some pretty impressive ways to target offers. I don't know if you ever log into your credit cards and you see like, an extra 2% back at this merchant, activate the offer and things like that. So they're building out ways to target offers to PayPal and Venmo customers using purchase data and AI. So, really just very targeted and more effective. And they get money from that. So that's just one example of what they've been doing so far. Again, very earlier in their tenure. Alex Chris, the CEO, called 2024 a transitional year for PayPal. They're really just trying to figure out what they're going to do from here. Because obviously the growth at all costs mentality of 2021 and the pandemic era is not a sustainable strategy. And one announcement they just made 2 days ago is that PayPal is going to start building out an advertising platform. I'm kind of shocked that they don't have one yet. I kind of always thought that PayPal did some targeted advertising, but they're starting to build an ad network that they're going to sell targeted ads on to merchants, and they're going to use all their customer purchase information from Venmo and PayPal and customer shopping patterns in order to better target these ads. The idea is that PayPal has 427 million active users. That's a lot of consumer data and a lot of potential eyeballs on advertisements that you can really target and kind of create a lot of value for advertisers. They just made another big hire. That's why I mentioned a lot of their leadership is very new. They added another one. They just hired the ex general manager of Uber's advertising business to start building this out. To be fair, there is some competition here. J.P. Morgan Chase recently, essentially said they're going to do the same thing. They have that massive credit card business that gives them a lot of purchasing data, so they're going to use that to start selling some targeted ads to people. But I kind of like PayPal's version a little bit better, the way they describe it, just because of how they reach customers. I don't log on to my credit card website and expect to see advertisements from third parties and things like that. But when I'm in my Venmo app, it would just be kind of a different feature and a different thing on the screen, kind of like how you see it in your social media. So I think that is a lot of potential. And whether or not the advertising is really a needle mover, the point is that the new management team is kind of hitting the ground running and innovating and doing its best to increase engagement and really try to figure out ways to build the platform going forward. And by the way, I don't think user growth is dead. I think it's just kind of a lot of it was pulled forward during the pandemic years. You're seeing a lot of that kind of trickle off the less engaged users and things like that. But I think long term there is potential to increase the user base, maybe not to 750 million or a billion in a short amount of time, but they could return to growth. It's not out of the question. So essentially, this is a stock price for zero growth. They lead their industry, and I think it's kind of a no brainer right now. And I've been rambling for a little bit, so let me kick it over to Tyler.
I was just going to mention with, pay 12 too, with, I think the person that they brought in to do their ad business came from Uber and was able to really like spin up that ad business relatively quick. So it's kind of like a shot in the arm, if you will, in terms of revenue. Whether that's something that's going to be like a huge, like perpetual growth machines to be seen, but a nice shot in the arm after basically being stagnant for so long is nice. The one I'm going to qualify mine a little bit because when we think about no brainers, we think about, well, at least in my opinion, I look at returns, right? Like I want to target a certain annualized return that I can feel comfortable with for many, many years. And that's kind of like where I want to go, like whether or not that's, you know, ETFs or whatever. But generally, if you can get like a 12 to 13% return, that's a really good return over the long term. I mean, the S&P 500 over its like 50, 60 years has been about 11. So if you can do a couple percentage points better than the S&P 500, you're killing it, really. As much as it may not sound like it. So with that in mind, a kind of targeting that percentage range of return, I'm looking at MPLX. This is something I've owned for quite a while. The name of the company is the same as the ticker, and I think I've talked about it a couple times here before. But one of the reasons that it makes sense to me as a business is the business model is very, very well, it's quite stable. So the majority of MPLX's business it provides logistic services, whether that be through pipeline transportation, gathering, storage, trucking, anything like that. The largest portion of it goes specifically to its parent company, which is Marathon Petroleum. It's a oil refiner. They own like something like 60% of shares anyways, and they've carved off MPLX as a separate kind of logistics business that throws off a lot of cash and pays a large dividend. And the majority of those assets are built to more or less handle everything that Marathon Petroleum's refining assets go, either in or out, as well as some other businesses in the gathering of oil and gas in various basins across the United States. So it's got some places to grow. It's a very, very slow growth business. I'm going to admit that right off the bat here. This isn't a business that if you're looking for like double digit revenue growth or anything like that, this is not the case here. It's very, very slow. It's a slow grower. It's going to be quite stable for as much as, oil and gas are commodities and swing wildly in price. It's a volume game for MPLX, and oil, gas and diesel demand in the United States doesn't really change a whole lot. Even in recessions, it may go down like a 1 or 2 percentage points. So the amount of volume going through the pipe at any given moment is pretty consistent. So with all of that in mind, you have a stable revenue model, a management team that is more or less geared towards preserving the dividend, because a lot of that cash goes back to Marathon Petroleum, which they use for their own purposes. But we as individual investors get a decent cut of it. They have been very good about keeping leverage down. The actual returns on invested capital have been very good because they're been very deliberate on what they actually want to invest in. And so when you kind of add that all together, you have a good business. It's probably going to be around for a long time. And this is where we start getting into, okay, well, what do I get for this? Well, right now we have a current forward dividend of about 8.9%, pretty much 9%, 8.97. So we're already looking at a very, very large payment right now. And over the past, depending on how you measure it, 5 years, 10 years, we had a 2020 was a bit rough for most oil and gas companies because of demand. So they actually kept their payments steady for a little while. But it's been anywhere between 5 to 10% growth over the past 5 to 10 years, but 5% being the worst. So if I've got a 9% yield now and 5% growth, I'm already looking at 14% in terms of return. And so that to me is a really attractive option in what is typically considered a slow growth industry. And with a little bit, maybe even a little bit more, like I said, up to 10% growth on that dividend. I doubt it's going to get that high because that has a lot to do with its very early days when it was growing its dividend at absurd rates. So, little caveat there. But all in all, I don't need a huge amount of growth when I have a 9% dividend. And as long as management continues to operate the business in the way it does, I don't see a eminent threat to it being cut or anything like that anytime soon. And so if I'm looking for like just something I don't have to think too hard about as terms of investment, MPLX looks pretty good.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.